On to today's presentation, Introduction to 401k Plans for Plan Sponsors. Today's presenters are Christine Hall and Tina Tufano. Before we get started, I'd like to point out the question mark icon at the top of your webinar screen. This is where you're going to enter in any questions that you may have for Christine and Tina. Feel free to submit at any time. Keep in mind that we will keep our Q&A portion till the end of the session. If time does run out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right below the questions, you will see, or right next to the questions, you will see a paper icon. This is where you can download today's material in PDF form. If you are unable to view or click on the handout, you can go ahead and send us an email and we can provide you with that PDF. If you are with us today to earn continued education credits, please be sure to stay until the very end to fill out our pop-up survey. This is going to allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can always follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce today's presenters, Senior Defined Contributions Account Manager Christine Hall and Senior Account Manager Tina Tufano.
Good afternoon, everyone. Thank you so much for joining us for our presentation of Introduction to 401k Plans for Plan Sponsors. Tina and I are so glad to have you with us today. This presentation is about 90 minutes long. We're going to be going over a lot of information. Of course, not everything to know about 401k plans, but we are going to be covering a lot of material. So I'm going to try to move pretty quickly through the information. I know that just given the topic that we have today, that this is Introduction to 401k Plan Sponsors, probably many of you on today's at today's webinar have a brand new 401k plan. So I want to congratulate you on that and hope that your 401k plan, new 401k plan, is a great benefit to you and your employees. So before we get started, just wanted to give our disclaimer. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional, such as an attorney or an accountant, if you need legal or tax advice. And then Yvette went over this information, but if you need CPA credit, just make sure you're doing the things right here, and Nova's provider number is here as well. Okay, like I said, we have a pretty full agenda today. We're going to be talking about the roles and responsibilities in administrating and running a 401k plan. We'll talk about Nova's cybersecurity measures and go over 401k basics, talk about the moving pieces in a 401k plan, how you get distributions from a 401k plan and possibly loans, and then finally we'll end the presentation with an annual calendar so that you have a heads up of how your plan's going to be running throughout the year with Nova. All right, so first, 401k plan administration roles and responsibilities. 401ks are kind of a niche in knowledge, and there's technical information that requires following IRS regulations and other regulations. So typically when you see a plan, there are 4 groups of people involved with the 401k plan. First is the plan sponsor, right over here, and that's you. Plan sponsors are responsible for the overall fiduciary responsibility of the plan. They're responsible to communicate the plan to their employees. And they're also responsible for depositing contributions that employees make from their pay into the plan's account. They need to provide information to the third-party administrator, the TPA, on an annual basis so that we can do the compliance testing that's required by the plan. Right beside plan sponsor, we have the financial advisor. Financial advisor is also often called a broker, and that's going to be the person who assists the plan sponsor with selecting a vendor to hold the plan assets and to monitor the plan assets. The financial advisor will help the plan sponsor to coordinate enrollment meetings and different employee education for the plan. They'll provide investment education, and they'll assist the plan sponsor with being 404C compliant. And what 404C compliance is making sure that the plan has a well-diversified fund menu for the participants to choose from. Then next we have the investment provider, and that is also often referred to as the record keeper or the custodian. That is the company that holds the plan's assets. It's where your plan's money is invested. They will have a website that your employees can log into. So that's how your employees are seeing the plan. The assets will be valued on a daily basis. Anytime that the stock market's open, the assets will be valued. And so employees can log into the investment provider's website on a daily basis if they would like to see updates on their account value. The investment provider is also responsible for distributing participant statements. That needs to be done at least on a quarterly basis. And those statements could be mailed directly to the participant's home address, or the participant could choose to have them electronically delivered. The investment provider is also responsible for making sure that distribution withdrawals happen as requested, and that the reporting that's required for the plan's assets takes place. Then finally, we have the TPA, which is also the third-party administrator, and that is how NOVA's role is done with your plan. And in our role as third-party administrator, we will prepare and maintain your plan document. We'll complete the required annual non-discrimination testing, and we'll prepare annual filings, such as the Form 5500. We're going to be going through how these three items that I just talked about work as we go through the presentation. And we'll also provide ongoing plan consulting for your plan. If your plan is already up and running with NOVA, you might already know this, or if you're still in our implementation process, you may not know this yet, but you will be given a NOVA account manager that works specifically on your plan, and that individual is who you want to contact, with any questions that you have about your plan, and will provide that plan consulting for you. Okay. Before we get into the specific 401k information, I do want to go over NOVA's cyber security measures with you, because you're going to be asked to submit census data to NOVA on an annual basis, and it's important that you feel comfortable with how we're getting your data and that it is coming to us in a secure way that won't put you and your employees at risk. There is a tremendous amount of money in 401k plans, so certainly the bad guys that try to hack into things and steal money have taken notice to this. They also attack record keepers, and this may start from a phishing attack or a hack on an employee's email. The attackers will then contact the record keeper to reset passwords, and then the next thing you know, with the new password, the hacker can request loans and distributions. So we want to try to prevent that. With ACH and wires, typically only trivial amounts can be recovered when this theft's discovered. So it is really important to do everything we can to prevent these kind of things from happening. And this type of theft is not usually covered by your plan's fidelity bond, fiduciary insurance, or E&O insurance. So we all need to be alert and do our part in preventing the fraudsters from succeeding. So like I said, Nova will request census files from you on an annual basis. You'll also be submitting census files to the record keeper, the investment provider, as well as deferral files, payroll files, address files, and even the non-discrimination test that Nova provides for you has parts of social security numbers on, dates of birth, employees' full names. So we need to be careful with this information. Also, the information that might be on the annual valuation reports that Nova prepares for your plan. Sometimes there might be a need for you to send tax forms such as W-2s, K-1s, or Schedule Cs. This type of information should never be sent via regular email. Ideally, if we can send it to each other through Nova's secure file exchange, that would be great. But at the very least, the email needs to be encrypted. Nova does have a secure web portal by using our plan sponsor link. You can see that the address is there, but your account manager will have at the bottom of every email that he or she sends a link to our plan sponsor link. So you can just click on that, log in, and then use the secure file exchange to send your information. Also, our annual census request is done through the plan sponsor link and allows you to submit the annual census data to us in a secure way. You never want to send these files through regular email. Similarly, you don't want to send distribution requests or anything like that through regular email. And going through that, the other things that Nova does to make sure that your information is kept secure is that we do have encryption on our software. If you're already set up as a contact for us on our for your plan and with access to plan sponsor link, and let's say you have a new person that is hired that'll be working with the plan, we will need someone who is currently authorized as a contact on the plan to give authorization for any new people to be added on the plan. We can't just take an email or even a phone call from a new person who says, oh, I'm the new HR person. Could you add access for me? We will need it from someone who has already been established, authorization from someone who has already been established to add a new person to the plan. Nova also has mandatory quarterly training for all of our employees to make sure that we are staying on top of how to keep information secure. And we have a password policy where all of our passwords are changed at least every 90 days. So like I said before, you want to use the census upload on Plan Sponsor Link to submit your annual census. And there is a secure file transfer feature, the secure file exchange on our website that can be used. You also want to limit the number of people that you copy on emails. If someone doesn't need to be copied on an email, you don't want to copy them on an email. And make sure that you always use complex passwords. And if you look here how passwords is written, passwords is an easy word, but it was made complicated in this example to make it harder for someone to guess what your password might be. Okay, so now that we went through NOVA's cybersecurity measures, I want to get into the basics of a 401k plan. So 401k plans were set up to give employees an opportunity to save for retirement on a tax-deferred basis. They're set up to be a simple way for employees so that employees don't have to spend a lot of time with the setup or anything. It's done through payroll deduction. So once they set up a certain amount that they'd like to defer to the plan, that's set up for them. They can pick an investment option that makes sense for them. And nowadays, there's even diversified fund choices where they can pick a target date fund that'll take them all the way through till their expected retirement date. So it is set up to be very easy for employees. Payroll deduction, studies has shown, has been the best way to save because it's a great form of self-discipline. So, and for many people, 401k is their biggest asset besides their home. So it's a very important benefit to employees, and that is why it's become so popular as it is. However, 401k plans are not necessarily designed to be easy for employers. There are a lot of regulations that go along with 401k plans, and these regulations come from the IRS and the DOL, and interpreting the regulations aren't always done through common sense. Using what people might consider common sense doesn't always help, and the rules frequently change. When there's new laws that come out, the rules of the 401k plan change. And in all cases, your written plan document is the control of your plan. So all plans are required to have a written plan document, and whatever that plan document says, that is how the 401k plan needs to be ran. And that's very important because that plan document is what the IRS and the DOL look at if they ever choose your plan to be audited. Now, the IRS's role in a 401k plan is that they want 401k plans to stay in compliance with the federal statutes and IRS regulations. They have come up with non-discrimination testing that needs to be done on an annual basis to make sure that the 401k plan is benefiting all employees and not just highly compensated employees or a certain group of employees. They are in charge of setting the rules for taxable events and the deduction limits, the annual contribution limits. All those limits are set by the IRS. They want the plan document amendments to take place on a timely basis, and they do look to see that the terms of that plan document are followed. On the other hand, the Department of Labor looks at 401k plans a little bit differently than the IRS. Their main goal is to see that employees are being treated fairly according to the plan. So they're specifically looking out for the employees. They look for things like making sure that the 401k contributions and loan repayments, if they apply, are being deposited into the plan on a timely basis. They want to make sure that the fund lineup that is being offered to participants is prudent and well diversified so that they can make good investment choices. They look to see that the expenses paid from the plan are reasonable, and the Form 5500 that is an annual form that needs to be filed is submit it to the DOL. Now, I talked a lot about the plan document and how it needs to be followed and how the IRS and Department of Labor would use the plan document if they choose your plan for auditing. So what that plan document does, it has the provisions that your plan has choices about. And that would include the eligibility rules for your plan, the entry dates for your plan, the definition of compensation, plan eligible compensation that's used, how employer contributions are allocated, and also the vesting schedule for your plan. That all needs to be defined in the plan document. And if there's ever any changes that you want to make to that, if those changes are allowable, the plan document needs to be amended. It is important that plan documents are amended timely. They need to, even if you don't want to make any changes to your plan, because regulation changes come out, laws change, generally the IRS does require that the plan document is updated every so many years. It's usually about every 6 years. And it is important that when those requirements happen, that your plan needs to be restated, that takes place, so that the new legislation can be updated. If you decide to make changes to your plan, or if there's new legislation where changes need to be made, those amendments need to be executed timely. And there are penalties for failure to execute timely amendments. So that's something that NOVA keeps track of for you as well. We'll make sure when a restatement needs to be done that that's communicated to you and your plan document is properly restated. Now, I did say earlier that sometimes common sense doesn't always follow with 401k plans and how things might work. So I'm going to give you an example of this. In this example, plan sponsor wants to exclude hourly employees from his 401k plan. And that seems like a good exclusion. It's easy to define, easy to pull out that group of employees. However, it is very, very important to always keep in mind that if your plan document doesn't say it, then it can't be done for your 401k plan. So if it's not written in your plan document that you're going to exclude a certain type of employee, in this example hourly, then they're not excluded. And the other thing is, if you are excluding employees from the plan, a certain group of employees, we also need to make sure that it's going to pass the IRS coverage testing. So even though it might seem pretty logical that a certain group of employees can be excluded, that is not always the case. So you want to consult, you want to ask your NOVA account manager if you ever have questions about whether an employee should be eligible for the plan or not. Another example of how something that might seem like common sense and may not make sense is this. What is the preferred investment alternative for an employee who puts money into a 401k plan but fails to make investment selections? Okay, so according to the DOL regulations, if an employee never made any investment choice to the plan, the default option needs to be a balanced fund or a life cycle fund. Now, you might say, well, wouldn't it make more sense to just invest that employee's money in a money market or a stable value fund until that employee decides to make an election, him or herself? Well, The Department of Labor says no, because you don't know how long it might take that employee to make a choice. And if that money were to be invested in the money market or stable value fund for many years, if the employee never makes an investment choice, then that participant's money would not grow as well as it potentially could in a balanced fund or a life cycle fund. So you might say, well, how would money ever get into the plan with the participant not making an investment choice? Well, if the plan is an automatic enrollment plan, or if an employer contribution such as a profit sharing contribution is made and an employee never made deferral choice him or herself, that's how it could happen that the employee actually never made an investment choice. And so it would have to go into the plan's default fund, which needs to be a balanced fund or a lifestyle fund. Like I said before, the Department of Labor finds it very important that 401k employee contributions are deposited into the plan on a timely basis. And this would also include employee loan payments. The small plan safe harbor time frame that the Department of Labor gave guidance on January 14th, 2010 says that contributions need to be deposited into the plan's account as soon as administratively possible after the pay date, but no more than 7 business days after the contributions were withheld. Now, small plans are plans that have fewer than 100 participants with account balances. If a plan is considered to be a large plan, the Department of Labor holds them a little bit more accountable even than that 7 business day mark to make contributions to the plan. What is currently stated is that it needs to be done as soon as administratively possible. Now, there is an old rule, and I stress that this is an old rule, that it needs to be deposited no later than the 15th business day of the following month. But this rule is old, and it has not been updated. And I have not seen the Department of Labor following this anymore. They do really want to see a pattern with how you make contribution deposits into the plan. They want it to be part of your payroll process, and being part of your payroll process, being deposited by the 15th business day of the following month is way out of what their expectations are. Generally, if from a timing standpoint for large plans, we tend to see that the Department of Labor is looking for 3 to 5 business days after the pay date. But the biggest thing is they're wanting to see a pattern, that this is part of your payroll process. How this might be found if you're not following these rules could be found upon Department of Labor audit. If it's found at that point and it was never corrected, you'd be subject to whatever that auditor's corrections are for that violation. If it's a large plan, your plan is going to require to be have an annual audit by a CPA, and they can often find if late deposits were made. But it is something that you want to be keeping track of as a plan sponsor as well. The Form 5500 that I talked about is also submitted to the Department of Labor, and you can look at the Form 5500. It's similar to an annual tax filing, but 401k plans are all tax deferred, so it's not actually a tax filing, but it reports the annual information about your plan to the Department of Labor. It includes things like participant accounts, certain fees that are being paid from the plan's income statement, and the plan's financial statement. And all the information that's on the Form 5500 is at the plan level. So no individual specific information is provided on the Form 5500, and it is publicly available on the Department of Labor's website. It is also required to be electronically filed. The Form 5500 is something that NOVA will prepare for your plan on an annual basis and have all ready for you to review and electronically file. One of the things that's required for all plans is to have a fidelity bond, and that fidelity bond is something that also needs to be reported on the Form 5500. And if your plan is a large plan, which means there are at least 100 participants with account balance, it is required that an independent CPA's audit report is attached to the Form 5500. Now, there are some transition rules with becoming a large plan. Your plan doesn't automatically become a large plan as soon as 100 participants with account balance is reached. You do have until there are 120 participants with account balances as of the beginning of the year. So once your plan is reaching that 100 mark, you want to know that it is important that you might soon need to audit your plan. When you're in that situation, you can also see if there's former employees in your plan that can be encouraged to take a distribution of their account. If their accounts are under $7,000, they can be cashed out. If they're over that, you can't force them to be out, but you can provide them with information that might encourage them to take a distribution of their account. Likewise, if your plan just dropped under the 100 participant mark, but you know that within the next year, you're going to be back over 100, it may not make sense to change to be a small filer and not get an audit for just that 1 year. In fact, sometimes not having it for that 1 year and then the auditors having to catch up with that 1 year can actually be more costly. So if your plan has more than 80 participants, it can remain a large filer. Before I said that there's payroll files that need to be provided to the investment provider, and that is something that will need to happen each pay period that takes place. And that can be a lot of extra work for the plan sponsor if that's being done manually. However, a lot of record keepers and payroll providers can work together through something that's called payroll integration. And that's where your payroll provider submits the full census file to the record keeper each pay date. And that file includes addresses, dates of birth, dates of hire, dates of termination, compensation, the deferral contribution information. And all employees should be included in that file, regardless of whether or not they defer. So that way the record keeper can keep track of who's eligible for the plan and give them the information that they need. So why should you use payroll integration? Well, it provides an easier way for your annual census data to be pulled from the record keeper if they have the information from each pay date. That could be a good way for you to pull the annual information. It allows the record keeper to process those automatic distributions. So if you have former employees that have accounts under $7,000 and each pay date, the record keeper is being updated with dates of termination, addresses, they'll know who's no longer employed with you. And once they can be notified. Um, and if there's no response within, it's usually 30 to 45 days, they can cash out those small accounts. It also will allow the record keeper to keep track of enrollment. So once new employee data is received, they'll be able to send out enrollment packets to the participants when they become eligible for the plan. And there's two different types of payroll integration. The first one, Payroll 360, that's where the census information flows both ways. So the payroll provider will give a census file to the record keeper each payroll period with all the information from that pay date and updates that might have changed in your employee census. And then the record keeper will send a file back to your payroll provider that includes any contribution deferral changes that employees submitted during the last period, hardship withdrawal requests, loan requests, so that the payroll company can update their information accordingly with those new deferral amounts or the new loan repayment amounts. Really, Payroll 360 is the easiest setup for the plan sponsor because that setup has your payroll provider and your record keeper talking to each other back and forth, and it gives the least amount of involvement for you. Payroll 180 is where the census just flows one way, and that's where the payroll provider is able to give the record keeper information each payroll period, but the record keeper doesn't provide any information to the payroll provider. So in that type of setup, the plan sponsor won't have to give anything to the record keeper on a payroll basis, but they will have to give any deferral changes that take place at the record keeper, new loan repayments, they'll have to communicate that themselves to the payroll provider. So as you can see, payroll integration can be a very, very helpful thing. So it's something that if you don't already have set up with your record keeper and payroll provider, you might want to look into to see if that can be helpful to you. Okay, and having payroll integration can be a way to prevent some plan sponsor errors, but I do want to go over some common payroll errors that can take place because some of these wouldn't be able to be prevented by payroll integration either. The first one is excluding bonuses from deferral elections. Your plan document defines what your plan eligible compensation is. And so you want to make sure that you know what that is for your plan so that you're including the correct types of compensation amounts when taking employee deferrals. Sometimes employers will think, oh, you know, I don't want to take employee deferrals from a bonus because I want my employees to be able to enjoy the full bonus. But if the bonus is not excluded from plan eligible compensation, that cannot be done. So you want to make sure that you know what your plan's definition of plan eligible compensation is. And if you ever think that you want to make a change, you want to check with that before you do anything with it, you know. So if you have a special bonus coming up, you don't want to just not withhold from that bonus. You need to make sure that bonuses are excluded from plan eligible compensation. Otherwise, it should be included. Excluding part-time employees from the plan. Again, if part-time employees are not specifically excluded in the plan document, then you can't exclude them from your plan. So it's very important to make sure you know which employees are included and which are excluded. Matching catch-ups separately. from non-catch-up contributions or matching Roth contributions separately from pre-tax contributions. So when you're matching employee deferrals, you want to add up all three of these amounts before you calculate the match. It is possible that one participant could have both catch-up contributions, pre-taxed contributions, and Roth contributions. Those are all considered employee deferrals. So when calculating the match, you first want to add them all three up and then calculate your match. Or if an employee makes both Roth and pre-tax contribution, add those two up. Or if it's pre-taxed and catch-up, add those two up first, then calculate the match. Payroll providers should know how to do this, but it's important that you're also aware that this is how it should be done in case there's any kind of manual calculation that you're doing. Not distributing the summary plan description, that is the plan document that must go to all eligible employees when they become eligible for the plan. Oftentimes, the record keeper will distribute that for you, but that is something that should always be available to plan participants. Not allowing new employees to participate in the plan. So if you miss when someone should enter the plan and you didn't follow your plan's eligibility rules, you want to make sure you know how, like when and how employees become eligible for the plan so that that doesn't happen. And also not capping matching contributions based on the annual compensation cap. And those last two, I'm going to go through those in a little bit more detail to better explain those. So not allowing participants to enroll in the plan on time. So in this example, ABC Company plan has no age or service requirement. That means that the plan has what's called immediate eligibility. But the plan doesn't offer Steve enrollment into the company doesn't let Steve know about the plan for the first 6 months. So Steve didn't have an opportunity to contribute to the plan for 6 months. And the ABC Company needs to make Steve whole by making an employer contributions for the missed deferrals and the match that he would have received had he been allowed to contribute to the plan. And then here's an example of not properly capping the match. If a plan's matching formula for 2025 is 50% on the first 6% of employee contributions, then the maximum amount of match that any one participant can receive for this year is $10,500. So how did I get that? Well, the other limit for 2025 is the compensation limit. And for 2025, the maximum amount of compensation that can be recognized for a 401k plan is $350,000. So if we take that $350,000 times the matching formula, the 50% on the first 6% of compensation contributed, that's how we get that $10,500. Now it's important to note that the compensation limit can change each year, and it often does get increased a little bit each year. So this number is going to change potentially each year. So if you're not sure what your match cap is for any given year, you want to check with your NOVA account manager on that. Okay. So initial eligibility into the plan. 401k plans are allowed to have a maximum waiting period of 1 year and age 21 with a minimum of 2 entry dates. A certain number of hours can be required in order to allow an employee into the plan, but that amount cannot be more than 1,000 hours. So you can, say that a year of service is needed and define that year of service as up to 1,000 hours. You can also exclude people under a certain age, but the maximum exclusion is age 21. So you can say anyone who's under age 21 is excluded from the plan, and that's allowed. So those are just the maximum waiting periods to get into the plan. Certainly, you can have your plan set up to have shorter waiting periods, and many plans do have shorter waiting periods than the 1 year and age 21. The initial computation period to determine if someone is able to go into the plan is the 12-month anniversary from the date of hire. And then if that 1,000 hours is not met in that first 12 months, then it changes to the plan year. And I'm going to show you an example of how that works. Let's say you just hired someone on April 1st, 2025, and your plan is using the maximum allowable service requirement to get into the plan, where you have to have 1 year of service, a year in which at least 1,000 hours is worked, and then after that is met, you get into the plan on semi-annual entry dates. So for a calendar year plan, that would be January 1st or July 1st. So the initial computation period for someone that was hired on April 1st would be April 1st, 2025 through April 1st, 2026. If that person worked at least 1,000 hours during that time period, again, we're not using part-time or full-time at all, we're just looking at that 1,000 hours. If that person worked at least 1,000 hours and that person is at least age 21, he will get in on the next entry date, which is July 1st, 2026. However, if that person worked under 1,000 hours during that initial computation period, then we look at the calendar year or the plan year for this plan. So we're going to be looking at January 1st, 2026 through December 31st, 2026. Were 1,000 hours worked during that period? If they were, then that individual will enter the plan on January 1st, 2027. Again, these are maximums that are required. Many plans have eligibility requirements that are less than the 1 year of service and age 21 with semi-annual entry dates. Dealing with rehires can be challenging because there's different scenarios with rehires, and the plan handles them different depending on the scenario. The first thing to keep in mind is if a formerly eligible employee ever has a single vested dollar in the plan, he or she never loses their prior service credits. So a former employee, no matter how many years they've been gone, if they became eligible for the plan, contributed to the plan, had $1, at least $1 in the plan, when they're rehired, they get into the plan right away on their date of rehire. However, if you have someone that did not meet the plan's eligibility requirements, so they never got into the plan, never had that dollar in, they will lose their prior service credits after 5 consecutive 1 year breaks in service. Okay. So having rehire, situations can be tricky. If you're ever not sure how to handle a rehire, make sure you reach out to your Nova account manager. We're always glad to look at the rehire situation and help you determine when they would be eligible for the plan. because you don't want to not let them in when they need to be, because then you could, have corrections that need to be done. But the biggest thing is if they were ever in the plan before, then they do need to be immediately allowed into the plan on their date of rehire. The IRS does have non-discrimination tests that are required to be done on 401k plans on an annual basis. That includes coverage testing, which tests based on how many people benefit in the plan. There's also profit sharing test, and that test, if the contribution is being allocated fairly between highly compensated and non-highly compensated employees. And then there is compensation testing, and that does not need to be done on all plans, but if your plan excludes certain types of compensation, then that excluded compensation needs to be tested to make sure that that is fair according to the IRS guidelines. The first test that we're going to talk about is ADP testing, and that compares the amount of deferrals that highly compensated employees make to the amount of deferrals that non-highly compensated employees make. Failure for the ADP testing usually results in refunds to the highly compensated employees. And those refunds would take place after the end of the year in which they're contributed. So who is a highly compensated employee for 2025? To determine a highly compensated employee, it can be based on compensation, and we look back to the prior year. So anyone who earned at least $155,000 in 2024 is a highly compensated employee for 2025. Also, anyone who owns more than 5% of the company is considered a highly compensated employee. And that is regardless of the compensation that that person earns. So even if that person did not earn $155,000 in 2024, if they own more than 5% of the company, they are considered a highly compensated employee. Linear family members are considered, of 5% owners, are considered to also own that ownership in the company, and they are considered highly compensated employees as well. So if the owner's child or spouse or grandparent also work for the company, then those individuals, regardless of their compensation, would be considered highly compensated. Another non-discrimination test that needs to be done is the top-heavy test. And if this doesn't look at highly compensated employees, it instead looks at key employees. And if the balance of the key employees, their account balance, the value of their accounts in the plan, if that value is more than 60% of the total plan assets, then the plan is considered to be top heavy, and top heavy plans are required to make contributions for all non-key employees, regardless of if they contribute to the plan or not. Key employees are a little bit different than highly compensated employees. Like highly compensated employees, anyone who owns greater than 5% of the company is considered a key employee, and it also uses that family attribution if family members of the owner also work for the company. Where it changes a little bit different is that if there is a 1% owner, that person could also be a key employee if that person's compensation is greater than $150,000. If there's an officer of the plan with compensation greater than 220,000, that person would also be a key employee. But other than owners and officers, if someone has a high amount of compensation, but they're not an owner or an officer or a family member of an owner, they would not be a key employee. So you might see with looking at that ADP test and that top-heavy test and think, how is my plan ever going to pass those tests? And the IRS realized that that could be a problem. So there is a solution, and that is called a safe harbor plan. And if your plan is a safe harbor plan, it will be exempt, considered an automatic pass on the ADP ACP test and the top heavy test. There are two types of basic safe harbor plan designs that can be chosen from. The first is the safe harbor matching contribution, and the basic formula for that is 100% match on the first 3% of compensation deferred, and then a 50% match on the next 2. The other option is to make a 3% non-elective contribution, and that is a contribution that's given to all employees regardless of whether or not they make employee deferrals to the plan. The other thing with the safe harbor contributions is that they do need to be 100% vested. And if you have either of these types, then your plan is considered a safe harbor plan. With that, I am going to pass the presentation off to Tina to jump in at the moving pieces.
Thanks, Christine. That was a lot to cover, but some really good stuff. So thank you. Hello, everyone. Good afternoon. I hope you're enjoying this presentation so far. We've got some more good stuff for you. So don't go anywhere. It isn't over yet. Christine, thank you, is going to help me with the slides because I'm having some technical difficulties on my end. So thanks, Christine. We're going to start with some moving pieces, who does what basically, as far as some important responsibilities regarding plan administration. We're also going to talk about distribution and loan basics. And lastly, a review of our calendar, our annual calendar that has some great information on some important deadlines. So talking about the moving pieces, Christine did get into this area a little earlier in the presentation, the difference between the record keeper or the investment provider, as well as the TPA, the third party administrator, which is NOVA, as well as the investment advisor. So the record keeper is where all of the investment transactions happen. They do all the participant reporting, benefit statements. They also provide NOVA with, or most record keepers, depending on the setup, will provide NOVA with annual reporting as well, which we will use to prepare the 5500. They also provide education and communication for both the plan sponsor and the participants. NOVA is a TPA. We are responsible for compliance testing and consulting, as well as optimal plan design and drafting. So when you have those questions about who's eligible, if you have a question, I have a rehired employee, what do I do? You're reaching out to us with those questions. You want to make changes to your plan, who's eligible to enter the plan, or to receive employer contribution allocations. We want to start excluding part-time employees. How do we do that? So, and optimizing benefits. Some plans may choose to provide a profit sharing contribution, and may want to target certain employees. So those are all the things that you can work with your account manager on. Also distribution and loan expertise, determining whether or not someone is eligible to receive a distribution. Of course, we're going to get into some more distribution basics in a minute. Nova is also prepares the annual 5500, which Christine also mentioned, which is an annual return of the plan, providing some basic information to the Department of Labor about the plan. And of course, we have the investment advisor, like Christine said, also referred to as a broker, who also has a relationship with the client, providing ongoing consulting for the plan sponsor, as well as investment review and education, providing education to both the sponsor and to individual participants. And will often be very involved in the enrollment process. Okay, Christine, we can move forward. Thanks. So how does the money get to the record keeper? Usually there is a secure website provided by the record keeper for plan sponsors to deposit those contributions. They should be deposited to individual accounts and to the appropriate contribution source. So that's important, making sure that deferrals, whether they're pre-tax or Roth after-tax deferrals, making sure that they're going to the appropriate accounts, and as well as employer contributions. So if you might have a safe harbor plan, that is, safe harbor contributions are 100% vested immediately, but you also offer a profit sharing contribution, which is subject to a vesting schedule. So it's important that those be deposited into the appropriate account so that vesting can be calculated appropriately, and distributions ultimately can be done properly. Oh, did I miss something? Sorry. Can you? Okay, so yep, that's good. Thanks. Okay, so matching contributions. So it's important to note that matching contributions, the basis that they're calculated, is noted in the plan document. It will say whether it's on a payroll basis or an annual basis. Payroll basis calculations are generally done by either the payroll company or by the plan sponsor. So they're calculating the match based on those deferrals for each particular pay period. Now, if it's an annual match, the match will be calculated by Nova, which means that we're looking at the full year deferrals as well as the full year compensation, if you have any compensation limits, to determine what that employer match is. If you have an if you have an annual contribution limit for the match, if you have an annual calculation period for the match, you can deposit it more frequently. And a lot of plan sponsors choose to do that. They will calculate it on a payroll basis and deposit it on a payroll basis. But if the document says that it's calculated on an annual basis, then that means that we'll look at what the formula should be for the entire plan year, and we'll compare it to what you've deposited based on what you've provided in the census. And we'll let you know if there are any additional amounts owed, which we call a true up. Okay, thanks. Who's responsible for preparing the 5500? So Christine mentioned that earlier. 5500 is an annual filing for the Department of Labor. It is prepared by Nova based on the reports from the record keeper. So we need those reports to include investment information, and then we'll take the participant counts from the census that you provided after eligibility is determined, and all that information goes into the 5500. We will prepare that, and we will send a link to the plan sponsor or whoever the 5500 signer is to sign it electronically. All 5500s are required to be signed electronically. If this is a new plan for you, then you'll need to establish, and you've never signed a 5500 before, it's okay. It's an easy process. We will send you information on how to obtain your e-signing credentials from the Department of Labor. And it's basically just linked to your email address. And then when you receive the 5500 from us, you can go ahead and sign it. So the 5500 also, I just want to note, is due 7 months after the close of the plan year, or if it isn't filed by then for some reason, then we will automatically file for an extension. The extension gives the plan another 2.5 months to file the 5500. So you don't need to request that from us. If for some reason for example, for a calendar year plan, the 5500 is due July 31st. If it isn't filed and signed by the week before usually, then NOVA will automatically file for an extension on your behalf. Thanks, Christine. Okay, distributions. So most of the record keepers allow participants to request distributions online. And so the record keeper can provide information on how they do that. But not all record keepers offer that. Sometimes participants can request distribution forms online instead of the actual electronic distribution. And also NOVA can provide distribution paperwork for those record keepers that do not require distributions to be requested online. So if you need to distribute distribution paperwork to them, form, for example, then we do suggest that you do that with as part of their exit interview, with their exit package, such as the COBRA notices that are often required. We do have a distribution team that works solely on distributions and helping to process them for most of our record keepers. But if you have questions about your distributions, or whether or not someone is eligible for a distributions, or what your plan document states, then please reach out to your NOVA account manager. Okay, thanks. The plan sponsor is generally required to distribute most of the notices. The summary plan description is one of the notices that Christine mentioned earlier that is a common failure. So all participants who are eligible to participate in the plan should receive an SPD. That's a summary of the plan document. It's put in layman's terms to make it easier for participants to read. I mean, for plan sponsors, if you've seen the adoption agreements, they can be quite large and have lots of checkboxes. And so the summary plan description is a summary of what the plan has selected for provisions. And it's much easier for participants to read. And of course, as a plan sponsor, if you have any questions about basic questions about the eligibility and so forth, you can also find that information in the SPD. The summary annual report is a summary of the 5500. It has basic information. Again, like Christine said, no individual data. It's all on a plan level regarding the assets, the participant accounts, where the money is invested, who to contact, if there are questions about the plan. This needs to be provided on an annual basis to anyone who is eligible in the plan, who's a participant in the plan. So this is part of the 5500. When you receive the 5500 from us, you'll also receive the summary annual report. Annual safe harbor notices are required for safe harbor plans. So these are plans that are making required safe harbor contributions. They are guaranteeing a safe harbor employer contribution each year. There are different types of formula that you can select, but a notice is required to be provided to participants at least 30 days before the start of any new plan year. So that's really important. That is one of the requirements to be a safe harbor plan, which does have a lot of benefits, including possibly, waiving top-heavy requirements and also waiving ADP, ACP testing. So getting that annual safe harbor notice is important. Again, just like the SPD, the SAR, and the annual safe harbor notices are required to be distributed by the plan sponsor. Okay. Special tax notice is also required to be distributed by the plan sponsor, but a lot of times it's distributed by the record keeper. Special tax notice is part of the distribution process. It's a notice that goes to participants when they're eligible for a distribution, and it lets them know what their options are for distributions, taking it as a cash distribution or rolling it into an IRA, for example, or a retirement plan, another retirement plan. It gives them their options and it discusses any possible tax consequences to that. So, which types of distributions are eligible for rollover and which types are not eligible for rollover. So that's really important. Like I said, a lot of times that will be part of their distribution package, and may be part of the package that is provided by your record keeper. Annual 404A5 fee disclosures. These are participant fee disclosures. So this is required to be distributed by the plan sponsor, but it's usually provided by the record keeper. They may make this notice available to you. It's letting participants know what types of fees that come out of their account. So oftentimes the record keeper might make it available to you and tell you where it's located and tell you that you need to distribute it, or they may offer distributing the notice for you. And sometimes there's a fee that goes along with that, but there are usually options with that. Qualified default investment alternative notice is a QDIA notice, as we call it. And it is for those participants that, in one of Christine's example earlier, she mentioned if investment selections aren't received, what do you do with the money? And she mentioned that money market, isn't really an option anymore. Putting it into a balanced fund is. But if you're going to have a default investment, so if you're going to deposit funds into an investment that the participant has not elected, then the plan needs to provide an annual notice to participants affected by it, letting them know that you do have this default investment and that they do have the option to go in and change it, make changes to their elections. Lastly, the annual automatic enrollment notice. This is for plans that have auto enrollment, which a lot of plans do now. Some new plans are even required to have automatic enrollment, which means usually that if you're not receiving an affirmative election from a participant, that you are enrolling them in the plan anyway, you're beginning deferral deductions. So, but an annual notice is required to be distributed every year to those to participants. Oftentimes it's part of a safe harbor notice if you have a safe harbor plan, so it might be part of that same notice. If you don't have a safe harbor plan, it would definitely be a separate notice. So that's a lot of stuff. Thank you. Oh, perfect timing for this. AFS is a sister company of NOVA's, and Administrative Fiduciary Services, they provide services to help mail the notices each year, which is a huge benefit for a lot of employers, because it's a lot to try to track down participants and mail things or know what can be provided electronically versus having to provide a hard copy. So if you have any questions about using AFS to handle those mailings, here is their contact information, proposal@afs316.com. And AFS does provides other services as well. We'll give them a little plug here, including assistance with census collection and distribution processing and signing 5500s and everything. So if you're interested in that, send them an email and they can provide you with more information. Thanks, Christine. Okay, moving on to distribution basics. Once the money goes into the plan, it needs to satisfy certain requirements to come back out. So you can't just take a distribution. And unfortunately, this is sometimes hard for participants to understand because they're like, this is my money. Why can't I take it out? Well, the IRS has restrictions on that. So it's very important that that participants understand that there are rules involved with that. And that's what your NOVA account manager is for, to assist you with any questions on that. Generally, money cannot be distributed from a 401k plan, definitely from 401k deferrals, unless they've terminated employment, including retirement. They've reached age 59 and a half. They have a hardship distribution, and we'll talk about that a little bit. There are specific requirements for a hardship, or they are deceased or disabled. So those are the general reasons for taking money out of a 401k plan. So if a participant has a termination of employment or they retired, the withdrawal request can be submitted prior to them leaving service, but it cannot be distributed from the plan until they are gone and have worked their last day. A lot of record keepers will require that final contributions be deposited before any funds are distributed. And that makes sense, right? Because if you process I leave today and a distribution is processed for me, but my final contributions haven't been deposited yet, well, now another withdrawal has to be made to process, to distribute the residual contributions that were deposited maybe 2 weeks from now. And of course, there's a fee usually every time a distribution is processed. So it does make sense to wait until everything has been distributed, even if it's allowed before your final contributions are deposited. And then this is just a reminder that the employer does need to provide a special tax notice, or let's just say the special tax notice needs to be part of the distribution package. Okay, so a plan can offer what's called an in-service distribution, which allows participants to take money from the plan while they are still employed. 401k money, safe harbor money, has some really heavy restrictions on it. So you cannot take money out, absolutely cannot take money out unless you're age 59 and a half, unless it's for hardship reasons or you're just taking it out as a loan. However, the plan is not required to allow in-service distributions. This is an option, and some employers like to offer this as an option, but it's not required. It can be allowed at an earlier age for other types of contributions. For example, if you have profit sharing money in there and you want them to allow it at age 55, or you want to allow it at any age for profit sharing contributions, you can do that as well. But the point of the plan is to keep money in there, right? So the IRS does make it difficult or has these restrictions because the purpose of the plan is to save for retirement. There can be other restrictions as well on in-service distributions, such as it can only come from money that's 100% invested. Maybe there's a minimum distribution amount and so forth, or you can just select certain types of contribution sources that the in-service distributions can come from. So there are lots of options there, and these are things that you can discuss with your account manager. Christine. Hardship distributions is one of those exceptions that if you're under 59 and a half, hardships can be allowed depending on the document. It is not required. It can be allowed from all contribution sources or just some, just like in service. The difference between hardship distributions and in-service distributions is that in-service is for whatever reason, as long as they satisfy those requirements that you've set forth in your plan document. A hardship, however, they have to meet a certain definition of a hardship. It is to allow employees to access their money in the event of an emergency. It is still subject to a 10% early withdrawal penalty tax, which all distributions under 59.5 are subject to a 10% early withdrawal penalty tax. This is one of those items that is discussed in a special tax notice that goes along with the distribution package. So just something to keep in mind. But it's, if your plan wants to allow for it, it's an option. And also the other something new from Secure 2.0 is that participants are allowed to self-certify their eligibility for a hardship, which means that they don't have to prove that they've had a hardship. Now, this depends on the plan, whether the plan allows this self-certification. They don't have to. They could require proof. And it also depends on the record keeper. Sometimes record keepers are requiring plan participants or requiring that they only self-certify or vice versa. So that's important to understand whether or not participants need to provide documentation that they actually had a hardship. Christine? These are the allowable reasons for hardship. So they have to satisfy these reasons in order to receive a hardship. Purchase of a principal residence. It needs to be their principal residence, not a vacation home. To prevent eviction from their home. Again, this is not, I need to make a rent payment and I don't, it's that you're on the verge of eviction from your primary residence. Unreimbursed medical expenses, post-secondary education, casualty losses. So if you're in a disaster area with all these hurricanes and weather issues, if you're in a federal disaster area, then that can be a reason for a hardship. And burial expenses are also another hardship reason. Distributions upon death. Distributions are payable to the beneficiary according to the participant's election, their beneficiary election form. It's important to know that married participants need to have their spouse as their primary beneficiary and sole beneficiary unless the spouse waives this requirement. So they would have to sign the waiver on the beneficiary form saying it's okay to elect someone else as their beneficiary. The plan document does tell us how to distribute the plan account in the event that there is no beneficiary form. So really, ideally, plan sponsors should be making sure that participants are signing election forms, that you have them on file, or maybe the record keeper is doing that for you. That's always possible, so a good idea to ask. But there should always be a beneficiary election form on file. In the event that there isn't, the document will tell us how to proceed. Thanks, Christine. Required minimum distributions. This is when distributions need to start beginning. It's at age 73 that they need to start taking out their money. There's a formula for calculating that, and it's based on the balance as of the previous plan year. 5% or more owners are required to take minimum distributions from the plan once they reach 73. However, most plans allow employees who are not owners to defer their minimum distribution until they've actually separated from employment. And the Secure 2.0 regulations are changing this so that this age will be, we've seen it change just recently from age 70.5 to 73, and now it will be changing to age 75 in the year 2033. Okay, qualified domestic relations order. This usually comes up in the context of a divorce. It's usually drafted by an attorney and signed by a judge, and it needs to satisfy a lot of requirements. So it is important that you contact your account manager if you're presented with one, if a participant lets you know that they have a quadro for a spouse or a dependent. So make sure you let us know about that, and we can provide you with the plan's quadro procedures and let you know where to go from there. Spousal consent is not required for most plans, but it is for some. If you, especially if you have a plan with old money purchase, plan money in it that allows for annuity payments, anything over $5,000 needs to have a spouse signature. So a lot of plans do not require this, but it's important to know whether or not your plan does require it. And of course, if as long as we're assisting with the distributions, we'll let you know that as well. Loan basics. How am I doing for time here? Okay. Loan basics need to comply with IRS regulations. Plans are not required to offer loans, but they can. It's very popular with participants because it's not taxed at the time of distribution and allows them to pay it back to their own account with interest. Again, it's not a taxable event, and if they're under 59.5, it isn't penalized either. Christy. Participants can borrow the lesser of 50% of their vested account balance, up to $50,000. They cannot exceed $50,000 in a 12-month period. It's very common that plans have a minimum loan of $1,000. They don't, but they usually do have a minimum amount because the participant is paying fees for this distribution, right? So we want to make it worth it. For a plan that allows 50% of their vested account balance to be distributed as a loan, they would have to have a vested account balance of at least $2,000 to get a loan for $1,000. Loans must be at a reasonable interest rate. They need to be repaid within 5 years unless they're taking it out for a mortgage. They are generally paid through payroll deduction on a post-tax basis. So it's only if the loan policy states that it's only paid through payroll deduction, then a terminated employee is not sending in loan payments. It's as long as they're employed, the loan payments will continue to be made, and the loan policy will state all of that. Will state how loan payments are made. It will state the interest rate, the period of repayment, if there's a minimum loan amount. So it's important that anyone who is requesting a loan has access to the loan policy with all of that information. And loans generally become due upon termination of employment because most plans only allow payments to be made through payroll withholding. There are fees associated with loans. Usually there's an origination fee for actually distributing the loan, and there could be a monthly or annual maintenance fee, and the participant typically bears the cost for that loan. So if participants are paying for distributions, that will come out of their account. The fastest way to get a loan is if you request it online through your record keeper, which many do offer. If not, it goes back to what we discussed before about distributions. You can request distributions through Nova Distributions, and we can help provide you with that loan paperwork. And of course, selecting ACH instead of a paper check is also a good way for participants to get that loan check quicker. Okay, here we don't have a lot of time, but I'll leave you with this. This is our annual calendar. There's some important dates on here to look at, including um, January 31st is when 1099s need to be provided to participants. Those are generally done by the record keeper. So if they receive a distribution in 2025, by January 31st, 2026, they need to receive a 1099. There's some other good information about here about when NOVA does their compliance testing, generally in February for a calendar year plan. And so I'll leave you with that to look at the rest of it, because it looks like we're up with time. Okay, so I
All
think.
right.
Oh,
Oh, go ahead.
so thank you everyone for joining us this afternoon. I hope that it was an informative and you enjoyed the presentation. If you have any other questions, feel free to reach out to me or Christine, or of course, reach out to your Nova account manager.
Awesome. Thank you so much. Also, a reminder, if you are needing the handout for today's presentation, there's a little icon at the top right-hand corner of the webinar screen. That is where you will be able to download today's handout in PDF form. If you are not able to download it, you can email us and we'll send that handout to you. For CE credit, please be sure to stay till the end, and there will be a pop-up survey. For any other questions, please be sure to email us webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can always follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Christine, and thank you, Tina, for your presentation today. And thanks again to everybody for joining us. We hope you have a great day. Bye.
Thanks everyone.
Thank
Bye.
you.
Have a great rest of the
Bye.
week.